The bad loan situation for India's public sector banks is actually worse than reported. So says Apocalypse Now. The latest report from brokerage firm Macquarie. CNBC TV 18's Alexander Mathew has the highlights of the second report that raises a red flag on the Indian banking space.
Governor Raghuram Rajan may have set a strict deadline to bring down stressed assets from a 13-year high. But the $59 billion figure being bandied about may only be a fraction of the actual assets under stress. In Apocalypse Now, a report by Macquarie Research, the brokerage firm says that several potentially non-performing assets are being hidden behind the screen of statutory debt restructuring and 525 refinancing. The report says 16 to 18% of the total loan book of banks could become sources of stress over the next 3 to 4 years. As of September 2015, only 11.5% of loans have been recognized as stressed. To be fair, these numbers and estimates aren't exactly new. In its biannual financial stability report in December, RBI had pointed out that gross NPA ratios of large borrowers increased significantly to 8.1% as on September 2015 from 6.1% in March. The RBI added that GNPAs of the entire banking system stood at 5.1% at the end of September versus 4.6% in March. Also, stressed advances, which includes GNPAs and restructured advances, rose to 11.3% in September from 11.1% in March. This reading by Macquarie has pushed it to lower its rating on the PSU banking space. It has downgraded State Bank of India to underperform from neutral with a target price of 168 rupees. Remember, the other PSU banks had already been assigned an underperform rating. The brokerage has also cut earnings per share estimates of PSU banks by 14 to 18% for FY17 and FY18 and lowered target prices by 35% on average. While PSU banks bear the brunt of this latest report, private banks have not been spared either. Macquarie has downgraded ICICI Bank and Axis Bank to a neutral rating, cut EPS estimates for both banks by 15 to 18%, and lowered the target price by 40 to 45%. This puts the fox in the henhouse as far as the sector is concerned, and with asset quality under the scanner, it advises that private sector banks with relatively lower exposure to highly leveraged groups may be the preferred investment target. In Mumbai, Alexander Mathew.
Well, once every year,